Okay, good afternoon and welcome, and also a welcome to all those who are joining us by webcast. Costa is an outstanding business. Over the last 5 years, Costa has more than trebled in size from 550 stores to 1,871 stores. And the profits have increased fourfold from £13 million to £50 million. This is a great tribute to John and his team, and today you have an opportunity to meet some of the key members of the team who've delivered such spectacular and profitable growth. As you know, we have equally ambitious plans for the future, and we aim to double the size of Costa worldwide over the next 5 years, in addition to exciting plans for the growth of our new brand, Costa Express. Costa has been transformed over the last 5 years from a small number 2 UK brand into the leading UK coffee shop brand with substantial profits and profitability, which is now capable of becoming an even stronger multinational business with a significant proportion of its enlarged earnings coming from selected higher growth international markets. This transformation of Costa is clear evidence that Whitbread is a good owner of the business and continues to provide the best ownership structure to create further value for Whitbread shareholders. We believe Costa has tremendous growth potential, and we're totally committed to delivering these plans for our shareholders. Our aim now is to explain in more detail the drivers of Costa's success, how we plan to deliver our growth ambitions, and to explain the financial dynamics of the different components of the business to turn this growth into substantial value creation for our shareholders. We're keen to make this value creation as transparent to the market as possible, which is one of the main triggers for today's investor meeting. Let me now hand over to John and his team to present their plans in more detail and then to answer your questions. Thank you.
Thanks, Andy. Good afternoon, everyone. It's a real pleasure to have the opportunity to share our perspectives on Costa's current performance and its potential for further strong growth. The format today is fairly straightforward. First, Matthew Price and I will take you through a short business review. Matthew is Costa's Finance Director. We'll then be joined by the rest of the Costa team in the front row here to answer your questions. As well as Matthew, that team comprises Jim Slater, our Marketing Director, Clive Bentley, Property Director, Adrian Johnson, Chief Operating Officer for the UK, Rob Gower, Director of our Corporate Sales, Scott Martin, the Managing Director of Coffee Nation, Andy Marshall, Chief Operating Officer for International, and Paul Smith, Director of our business in Asia. And finally, I'm delighted that Mr. Liu Zhong has been able to join us today. Mr. Liu runs our joint venture operation in Beijing and is also Vice President of our partner, the Beijing Hualian Group. For those of you who don't know BHG, it's one of China's most impressive companies, a leading hypermarket and department store operator with commercial interests right across China. We're delighted to be partnered with them and delighted that Mr. Liu is here today. Our purpose today is to describe the drivers of Costa's current strong performance and to share our view of the prospects for further growth into the future. And then finally, to give you a little more detail on the economics of each of the businesses that make up the Costa system. I'll cover the performance review and outlook. Matthew will do the business economics. Let's start with a review of performance. As Andy has indicated, by almost any measure, Costa's performance over the last 4 or 5 years has been very strong indeed. The total number of Costa stores worldwide has grown at a compound rate of 28%. System sales from those stores that's sales at retail, irrespective of ownership, whether equity or franchise, have grown at the same rate, whilst PBIT has grown at a compound rate of 30%. There are three key reasons for this. Firstly, the ability to engage positively with our customers. Secondly, and building on this core strength, executional excellence in the UK. And finally, the measured approach we've taken to international expansion, which has created a strong platform for future growth. I'll discuss each of these in turn, starting with customer engagement. This next slide, which some of you may have seen at previous presentations, shows what we call the hierarchy of customer needs in the UK. I make no apology at all for showing it again, because it's proved to be pretty much the same everywhere we operate, and it's informed every big decision we've taken in Costa over the last several years. It shows that convenience remains the number one reason for choosing an outlet or brand, but that coffee quality is now very close behind, followed by service, atmosphere, value for money, of course, and food. These are the critical factors for our customers, and we've responded to each one of them. Convenience is what's driven us to open stores at such a fierce pace, taking Costa to wherever our customers are and building a network that's now bigger than the number 2 and 3 brands combined. And that's why we've developed a flexible business model that means you can get Costa on the high street, in shopping centres and retail parks. You can buy Costa in supermarkets and bookstores, and you can get it when you're travelling, at airports, train stations, and service areas. You can even enjoy Costa in hospitals, in universities, and at the cinema. That's also why we've developed a strong wholesale business and why we're launching Costa Express. Next, the growing realization that not all coffees are created equal is why we're investing so much time and effort in ensuring we serve a consistent, better product. We celebrate it with our global Barista of the Year competition, and we communicate it strongly to customers. We're proud that most coffee lovers prefer Costa, and we're determined to make sure it stays true. We're also determined to give our customers the service they want, service that's built around our segmentation of customer needs. For us, segmentation doesn't mean dividing our customers into different demographic groups, slicing and dicing the market by age and gender. It means treating customers as individuals and recognizing that they have different needs at different times. There are 3 broad types of coffee shop occasion. Recharge, a quick cup of coffee, usually to take away. Refuel, coffee plus a snack. And the largest, relax, coffee as a break, usually with friends. The service each occasion needs is different. Fast and efficient for recharge, warm and friendly for relax. We tailor our service style to deliver both at the appropriate time. We want to be famous for fast and famous for friendly by focusing on flexible, responsive service. Atmosphere is driven by the same imperatives, making attractive spaces available that are geared to customer needs on the occasions on which they visit us, and ensuring that our stores are kept fresh and inviting to underwrite the coffee experience that customers come to our stores to enjoy. Value for money is achieved by ranging, by offering products that meet different needs at different price points. For example, the 3 sizes of our coffee, offering more value for money on larger sizes, a higher unit price, but lower spend per shot of coffee. Interestingly, and this has been true for a long time, most people buy the larger sizes. We're also careful about pricing. Since 2008, despite 3 changes in VAT, the real price of a primo latte or cappuccino, that's net of tax, has increased by only 3%. That's less than the saving on the coffee club. And finally, ensuring that customers who do come to us for a snack can find great food that goes with coffee. not main meals, but sandwiches, salads, wraps, cakes, pastries and muffins that meet their needs and internationally respond to different local tastes. If that's the template for our overall strategic direction, the real key to our financial performance has been the ability to execute excellently in the UK and to out-execute our competitors. You're probably familiar with our UK performance. System sales have grown by £300 million and we've opened 685 stores in 4 years. We've also refurbished almost all of our estate to the latest up-to-date standards and maintained strong like-for-like growth across our entire network. But at the heart of it all is our excellence as an NSO machine, opening new stores better and faster than competitors. Now, a year or so ago, I presented this slide, which used as an example the small town of Chelmsford, where a succession of new store openings had added to growth. In the Q&A, someone said they'd like to see this market a year later to see if we'd sustained that performance. Well, here it is. 1 year on, and we've added yet another store. We've got more like-for-like growth. And over a 5-year period, we've grown our sales from this town from £600,000 a year to well over £2 million a year. There are literally dozens of examples like Chelmsford in the UK and many more where similar opportunities exist. And these stores look great. We refurbish all of our units on a strict 3 to 5 year cycle dependent on sales levels to ensure that they're fit for purpose, offering a beacon of hospitality in their neighbourhoods. More importantly, perhaps, refurbishment enables us to move the store design along, keeping it fresh and contemporary, in line with customer needs and ahead of the competition. But this isn't just a story about excellence achieved by investment, about growth driven by CapEx. We've enjoyed 9 straight years, 36 consecutive quarters of like-for-like sales growth, and all ages of like-for-like Costa stores are in growth. Last year, even those opened before 2007 grew by 6%, and those few remaining unrefurbished stores grew by 3.6%. And the combination of customer engagement and executional excellence has clearly made Costa the UK's first choice coffee shop. This is the YouGov tracking data we use quarterly. It clearly shows us ahead of our competitors. Another recent external survey gives Costa an even bigger lead, a 2-to-1 advantage. It's this survey we chose to support our advertising campaign that Costa really is the UK's favourite, the #1 choice for a great coffee experience. It's a position we're determined to replicate in Costa's international business, where a measured, prudent, phased approach to expansion has given us additional growth. This is a story of steadily growing confidence. We began around 10 years ago with tentative self-financing steps into Middle East franchising. As these businesses prospered and as our UK operation built scale, we accelerated with equity investment from 2007 onward, first in China, then in Russia, and finally in Poland with the acquisition of Coffee Heaven. Between these two brands, we now have over 650 stores in international markets. Our international growth is based on 5 strategic criteria. First, we target large-scale markets or regions. We then look for rapidly growing economies with increasing consumer affluence. We seek out markets with low current coffee shop development and hence greater incremental opportunity. And finally, we seek out local expertise to strengthen our capability. These criteria make it easy to understand our current priorities: China, India, Central and Eastern Europe, the Middle East, and Russia, the world's fastest growing markets or regions. And this is where we currently trade. At some point in the future, we'll turn to Latin America, Southeast Asia, and Turkey. Basically, it's as you'd expect, the BRIC markets plus those with BRIC characteristics. The coffee shop market in these regions is massively underdeveloped. The urban population of our current priority markets extends to 1.5 billion people, with just 11,000 stores. In the UK, the urban population of 55 million is represented by 3,500 shops. There are just 7 shops per million in our priority markets compared to 63 in the UK. And clearly, not everyone in these developing markets can afford Western brands, but many can. And one day there'll be 5 or 10 times as many shops as there are today, and we'll be there. Our approach to customer engagement in these markets is necessarily more flexible than in the UK. The top priorities are unchanged, although sometimes the order varies just a little bit. And in addition, there's often a greater emphasis on brand trust. Social occasions are even more important. It's more of a special occasion. And food has to conform to local tastes. Not local food exactly, but Western coffee shop food with a local flavour, a local twist. Our focus on key priorities is paying off. We're building scale by developing deep rather than broad, by putting down roots rather than planting flags, by building meaningful businesses in important markets and not scattering Costas like confetti in capital cities around the world. China shows just how this can work for us. Matthew will give more detail, but to describe the market, we've got 2 joint ventures, 2 great partners, one in the north, one in the south. We're focused on the most developed regions with the highest share of population, the highest share of GDP, and the highest share of growth. We've been there for 4 years, and we already have 95 stores. In fact, Andy, Mr. Lowe, and I will open our 100th store together in China at the end of June. Now, the Middle Kingdom is clearly absolutely central to Costa's future growth. But I'd like to reassure you that our growth opportunity is far broader than that. In total, we aim over the next 5 years to double our system sales to £1.3 billion, to increase our global store count to 3,500, and in the process more than double PBIT to well over 100 million. We see 4 distinct sources of growth. Firstly, we believe we can add 700 new UK stores. We also see very strong potential in our wholesale business and Costa Express, and like-for-likes in the UK will add further growth. And then finally, there's international. I'll discuss each of these in turn, starting with new UK stores. The biggest reason for believing in the UK growth story is that both penetration of coffee shops and frequency of visit are still low. Penetration is growing nicely. It's up from 50% in 2009, 50% of adults, to 54% in 2010. But still, 46% of all UK adults, almost half, didn't visit a coffee shop in the last 3 months. And those who did, well, they barely came more than once a week on average. The opportunity to grow this is tremendous. Increase penetration by a half, add just 1 more visit per fortnight, just 1 more, and the market doubles. And we're well placed to capitalise on this opportunity, because there are still 30% of all UK adults who don't live within easy reach of a Costa. 30% of UK adults who have to settle for an inferior coffee, or God forbid, no coffee at all. One of the ways we'll reach these people is by continuing to develop new channels. This is a recurring feature of Costa's success. A couple of years ago, we began with hospitals. We now have 20, with more to come, and we've also opened in universities, including a flagship unit at Warwick that does over 20 grand a week. Later this month, we'll open our first 2 drive-thrus. For us, it's all about taking Costa to where our customers are. That's why we're so positive about the opportunities in wholesale and Costa Express. We already sell 80 million cups of coffee a year through third-party customers. That's in addition to our franchise business. Costa Express takes this to a whole new level. In wholesale, we make a good manufacturer's margin. In Costa Express, we share the retail price with our customers to deliver even stronger unit profitability. With these 2 formats, as well as equity, franchise, and concession stores, there really is virtually no out-of-home location we can't reach with Costa. Now, just a word on Costa Express to let you know how we're doing. We acquired the business in early March, and the first Costa Express units, as some of you have seen, are now available as planned. Those of you who haven't tried the coffee might want to do so after this session. You might notice a slight difference, I have to say, because the machines use semi-skimmed milk, not full-fat or skimmed, but it's the best coffee that you can get in any on-the-go situation. Trials will be completed by the end of June, and we'll be in full-scale rollout in July. We're on track, and we have clear plans to rebrand 500 units this year and to place 200 new ones. And the opportunity for Costa Express really is enormous. We estimate conservatively that there are a minimum of 21,000 locations that could take a Costa Express unit. They're focused on travel, on business and industry, and on retail. And frankly, we target a very small share of this opportunity with our market-leading concept, 3,000 units by 2016. But as with our current performance, growth isn't just about new units, about new markets and capital investment. It's about driving like-for-like growth. Driving like-for-like growth with marketing initiatives and innovations. It's about growing by strengthening still further our engagement with the customer. It's about adding more physical capacity, more tills, more machines, more seats to cope with the increase in demand, ensuring our 9-year run of like-for-like growth continues. The kind of innovations I'm talking about are things like Flat White, the great new product that quickly became 5% of our total coffee sales. Or Ice Cold Costa, 16% of total beverage sales last summer. And initiatives like our breakfast program, which grew morning sales by 11% during 2010-11. This is the kind of promotional intensity we need to deliver our growth agenda. We also have a tremendous vehicle for connecting even more closely with our customers. Around 40% of our transactions are now on the Coffee Club card. That's great. It rewards loyal customers, it encourages them to visit Costa more frequently, and it makes them feel better about the brand. Just as important, however, perhaps more important, online registration gives us the opportunity to understand purchasing behavior better and tailor promotions specifically for individual cardholders. And responding better to customer needs is exactly what we're doing with the new Metro stores that are opening up all over London, giving Costa a younger, edgier, more contemporary look that's even more appropriate for the urban metropolitan marketplace. These stores and many others are getting bigger. It's our deliberate policy at home and abroad to build bigger and bigger stores to cope better with the growing demand. In 06-07, our average new store occupied 1,200 square feet. The stores we opened last year were 33% bigger, building capacity ahead of demand. Because our estate is growing faster than our competitors, we can take advantage of this opportunity to build better stores to a greater extent than any of our rivals. And if new stores are better than old and we're opening more, then our estate isn't just getting bigger, it's getting better and better and better. And that's really the key to like-for-like growth. making our business better and stronger by becoming more relevant, more attractive, and more accessible for our customers with more capacity to meet demand. It's a vision we plan to extend to international, where we aim to grow to 1,600 stores, split roughly evenly between stores in franchise markets and equity, joint venture, and new territories. There are two key reasons for believing in this growth. Firstly, there's the potential internationally, and it's not just long-term, distant potential. The international opportunity is real, immediate, and tangible. As I said, it's true that not all urban inhabitants in our target markets can afford Western brands, but many can. In fact, taking Euromonitor's definition of the consuming classes globally, there are already 3 times as many in our current priority markets as there are in the UK. And yet, we have only half as many stores. In fact, there are already more real consumers in China than there are in the UK. Next year, there'll be many more. The year after, still more. In a few years, there'll be double. Secondly, it is a long-term sustainable opportunity because international customers are much younger than UK customers. Only a third of the folks who come to our stores in the UK are under 35. In our current international markets, the number ranges from 60% to 90%. The customers whose custom and loyalty we win today could be with us for decades to come. All of this paints an attractive picture of future growth, and I genuinely believe in it. In the UK, it's real and attractive, and our ability to secure it is proven. Internationally, by definition, it's less certain, but the long-term potential is almost limitless, and the short-term opportunity is right there to be had right now. Of course, there are challenges. 3 in particular stand out. The competitive environment, which might curtail our growth, the need for local adaptation, which might undermine its attractiveness, and the pressures on the organisation, which might limit our ability to achieve it. A few minutes on each one. First, on competition. I'm often asked how I feel about new entrants to the market, McDonald's, for example. The truth is, we've always competed with a broad range of rivals, from other international brands, through cafes and restaurants, local operators, to QSRs and sandwich shops. Actually, we like competition. It leads to market growth and category development. But to win, we have to invest in brand differentiation. 7 out of 10 coffee lovers prefer Costa. Drive customer engagement. 1.2 million active coffee club members, deliver a great atmosphere and service, as famous for fast and friendly as we are for coffee, and we have to ensure cost competitiveness, as good as the best cafe, as efficient as QSRs. This focus enables us to adapt our brand wherever we need to better meet the needs of coffee lovers everywhere, not changing the core coffee product, but adapting the things we need to change with flair and focus, not reluctantly, but with enthusiasm, to make sure that our stores, our service, our food combine to give all our customers an unbeatable coffee experience on their own specific terms. Doing this, of course, will stretch our organisation. We're very aware of the step change we seek to achieve, from 650 million to 1.3 billion of sales, from a UK company with overseas offshoots to a genuine international business. It's not just more of the same. It's a genuine transformation, a transformation that requires we make the organisational changes to ensure success. It means combining experienced operators with outside hires who bring new perspectives. That's why we have seasoned leaders like Clive and Adrian, who have almost 20 years Whitbread experience each, as well as new hires from places like McKinsey, Nokia, McDonald's. It also means combining local capability with a global vision. For example, all our Polish team are Polish nationals, and only 2 expats work inside our two China joint ventures, both of them rising stars for the future. And as much as anything, it means maintaining Costa's culture. We've built our business as a challenger brand. We're now a market leader in the UK at least, and developing into one internationally. We need to avoid the complacency that kills leaders and keep the challenger mindset that's built our success. We're determined to do it, to build an even stronger business with continued growth across the next 5 years and beyond, legendary growth that's built on absolute focus on the customer, extending UK leadership, and achieving genuine scale internationally. We're committed and excited about the prospect. Thank you very much. I'd now like to hand over to Matthew, who'll show you how he models our future.
Thank you, John. And good afternoon, everybody. So I'd like to build on what John has said by discussing the sales, the profits, and the economics of Costa's different businesses, and by showing how these come together in the growth targets that we've shared today. And I'll also discuss Costa's cash flows, its levels of investment and returns from this. So Costa operates in two main ways. The traditional retail business, where it runs the stores, and contract businesses, where our partners operate the brand, in one of three main ways. And these ways are either as franchise stores, as wholesale customers, or by hosting Costa Express units. The traditional retail business comprises a little over 2/3 of our profits last year, whilst the contract businesses together contributed 1/3. In our retail businesses, our businesses in the UK and in Poland are well established in their markets, the stores are profitable, and the markets are profitable for Costa. Whilst in our new international markets, we've achieved profitability at the store level, but the businesses are currently subscale, so aren't profitable at the market level for us yet. Looking at the system economics, Costa reported sales of 425 million for FY11, and in this presentation, we'll actually be referring instead to system sales, which total 659 million for that year. We believe that in a business with a significant franchise operation, system sales, which include the sales of franchise stores, is the most relevant measure to help you understand the economics of the business. It's certainly the one that we use internally. There's a reconciliation of company sales to system sales in the back of the pack. Costa's total contribution from trading was £72 million last year on system sales of 659, which was supported by overheads of 22 million, which gave a total divisional profit of 50 million. The UK business is 2/3 of our stores, 3/4 of our sales, and the vast majority of our profits, with £3 million being earned in our overseas businesses. In our UK equity stores, we made a contribution of 58 million last year, which is 3/4 of the total before UK marketing costs from the UK. Our UK franchise and wholesale businesses, between them, are almost 200 million of system sales and generate 20 million of contribution. They generate this income through a combination of royalties on sales and the margin on the sale of coffee and branded consumables into the wholesale business. Our franchisees and wholesale customers make the investment in the facilities to serve the consumer, and therefore the return on capital on these businesses for Costa is very high indeed. Looking at international, the international business includes the profitable international franchise business of 100 million sales and 6 million of trading contribution, and the equity and joint venture companies overseas, which are still making startup losses. I'll provide some more information on the equity market so you can understand them better in a few slides' time. But now I'm going to sort of move through each of the businesses in turn and provide some highlights. So, looking at UK equity, the coffee shop business, at the year end, we leased and operated 736 stores in the UK. On average, they delivered sales of £440,000 last year and a contribution of £83,000 each. A Costa shop has a very high percentage gross margin with variable costs, which are coffee, food and consumables, of about 32% of sales. Well, whilst offsetting this, the shops have some very substantial fixed and semi-fixed costs. So our shops are small, as you know. They occupy strong, high-volume locations with commensurate rents. And the average coffee shop will actually employ only 8 people, who between them cover 7 days trading. Therefore, in reality, a lot of our labour cost is essentially fixed. Looking now at the returns that we're earning on a new UK equity store investment, and this data is for stores that we opened in FY11. A new store costs us approximately £230,000 to build and fit out, and it generates in the first year sales of £449,000, store cash contribution of 25%, and together these deliver a return on capital invested in the first year of around about 39% on the year one. Clearly, the UK retail business faces cost inflation at the moment, which is exacerbated by the very substantial growth in coffee prices in the world markets. I'll delve more deeply into coffee inflation on the next slide, but I first wanted to give you the picture of inflation as a round. We're making pay rises of about 3% to our colleagues and managers in the stores, which is obviously linked in some way through to the minimum wage settlement. And in terms of other cost inflation, we're working very hard to use our growing scale and international scale to offset the market inflation that you're seeing in dairy, in wheat, etc., at the moment. However, this year, at this stage in the year, we're expecting about 2% cost inflation in these other costs. And obviously then coffee inflation, 30 to 50%, depending on the component. So to offset this level of cost inflation and hold our profits in mature stores, we need to deliver between 2 and 3% growth in like-for-like sales this year. Looking at coffee, Costa is a roaster and a retailer of high-quality espresso, and therefore we have a significant exposure to raw material and commodity prices. And what this slide does is explain the level of this exposure so you can understand it better. We import green coffee beans, and we roast the Mocha Italia blend at our roastery in Lambeth. And this year we will purchase and roast about 6.1 million kilos of green coffee. Of this 6.1 million kilos, a third will go into our own equity stores in the UK and overseas, and the other 2/3 will be sold to our franchisees and wholesale customers. Our wholesale customers have shared the cost of recent price rises with us. And without wanting to reveal the recipe for Mocha Italia, of course, not all of our coffee is Arabica, which has seen the highest 50% increase in our average buying in price over the last year. Robusta has seen a slightly more modest increase. We don't formally hedge coffee forwards, but to secure some of the specialist coffees that we need, we do buy forwards quite a long way, even in a normal year, to secure supply. And at this time in the year, we have almost all of our year's supply secured, and that with fixed prices on nearly half of it. John talked earlier about the importance in the UK business of keeping our stores fresh to drive their customer appeal. And in an increasingly mature UK estate, refurbishment is a significant investment programme for us, and so it's important that it's both well controlled and that it delivers a return on this investment. We refurbish our stores every 3 to 5 years, depending on the level of trade. Clearly, busier stores start looking tired sooner than quieter locations. And our average refurbishment cost last year was £70,000, about a third of which is life cycle maintenance, replacing a fridge or a coffee machine which has reached the end of its life. The other 2/3 of the project cost enhances either the store environment, makes better use of space, or offers additional product to our customers. And it's that component that we look for a return on, and which has been delivering a good return, actually. So on average, over the last 5 years, our refurbished stores have delivered an 8% sales uplift on refurbishment compared to control groups. And the incremental margin on this uplift pays back the enhancement investment over 2 years. Yeah. As you would expect, given the number of stores we've opened in recent years, we're going to be doing more refurbishments in the future than we did last year. Last year, we refurbished 78 stores at a total cost of about 5 million. This year and going forwards, we'll be doing about 130 stores a year at a total annual investment of around 9 million. Our UK franchisees operated 481 stores at the end of last year. These stores each had sales of around 380,000 and made a trading contribution to Costa of £29,000. Our franchisees range from individual owners who run perhaps 5 stores to large corporate franchisees like Moto, Roadchef and Esso. The franchisee owns or leases the premises, pays for the fit out of the store and then manages and runs it. What Costa does is it provides the franchisee with support and also supplies food, coffee and consumables at the same price that we sell to our own equity stores. So Costa earns its income from a royalty payment on sales by the franchisee. And this royalty model works really well for Costa because our goals and the franchisees are aligned. Both parties grow their profits by driving like-for-like sales and by opening new stores. The franchise business is almost capital-free for Costa, and so it earns a very high return on invested capital for us. Wholesale has been a really important part of Costa since before its acquisition by Whitbread in 1995. And last year we sold 82 million cups of coffee in the UK through wholesale channels out of 3,000 wholesale locations. So it's a very sizable business for us. Costa supplies coffee, cups and some consumables to the wholesale customers, and we earn a manufacturer and brand owner margin on these sales. Last year, this contributed £7 million of profit to us. And like the franchise business, it's a high return business for us. The economics of the wholesale business favour large accounts that are efficient for us to serve, and these large wholesale customers like Whitbread's hotels and restaurants, Compass Group and Sodexo are also growing businesses. And we've focused the wholesale business on serving these major customers. And last year, our top 10 customers comprised over 2/3 of our sales in wholesale. Turning to the Coffee Nation business that we recently acquired, the unit level economics of the Costa Express and Coffee Nation units are very strong and returns are stronger than in our UK equity stores. The units are placed at customer sites on a revenue sharing model, which minimises fixed costs. So, and the average unit has sales of £32,000 a year and a cash contribution margin of 32%, which is 25% after charging depreciation. A new Costa Express unit costs approximately £13,000 and in the first full year will deliver a return on invested capital on this of 60%. So we see Costa Express as a fantastic opportunity to deliver a great cup of Costa coffee to customers on the go, and really importantly, to deliver it at locations that cannot be and could never be economically viable for a full store offer. Our international franchise business operates on substantially the same model as the UK one. It's performing well and operated 447 stores at the end of last year, with each store contributing £15,000 of profit to Costa. Really importantly, our franchisees internationally are growing their sales and growing their own businesses very well. So they're growing by, on average, of 20% a year over the last 2 years to total system sales of 103 million. And our contribution from this business has grown slightly faster as the increased scale makes our support costs more efficient. And over the last 5 years, Costa has invested its own capital in equity stores in the high potential markets of China, Russia and Poland. And we've grown the number of these stores 5-fold, from 44 to 207 stores at the end of last year, which include 95 stores in China with our joint venture partners there. Looking now at China, with these Chinese joint venture partners, Costa has developed solid investable store models. And we really see this as the critical first step to building a large-scale profitable business in China. The average store has sales of £220,000 a year last year and a store cash contribution of 20%, which is 12% after depreciation costs. Compared to store investments in the established UK business, a new store in China will require a little less than half the initial capital cost to build and fit out, and will then deliver a little bit more than a third of the sales in its first full year. And in its first full year, our stores in China are making a 10% return on invested capital, and we're targeting a 25% return in the second full year of opening. And the main reason we're targeting such a steep growth from 10% return to 25% is because as the stores and the brand become better established in the market and their local markets, we're experiencing very significant sales growth as their stores mature. So in the established UK market, a new Costa store will see 14% growth from its opening month sales across the first 3 years it's open, whereas in China, a 3-year-old store will have grown its sales almost threefold compared to what it opened at in the first month. So building our brand awareness in the Chinese market to accelerate this growth is a key priority for Costa to really to allow us to get up this sales curve more quickly. Looking at the China market overall, now that we've established store level profitability, our key priority is to continue to invest to grow the number of stores in the country. So that the total profit from the stores, which is the upward sloping line, exceeds the cost of the in-market fixed costs required to operate the business in the country. This chart is an illustration, but we're targeting for China to become a profitable market for Costa in the next 18 to 24 months, when we intend to be operating between 150 and 200 stores in the country. That's the kind of targets for market profitability. And in Poland, the Coffee Heaven brand that we acquired at the start of last year is the clear market leader. Coffee Heaven stores now make very similar store contribution margins to our UK equity shops. And the cost of a new store in Poland is very significantly lower than a new one in the UK. Outside Warsaw, the branded coffee shop culture is less well established. It's still building, and so stores take longer for their sales to mature. We're seeing build-up curves of 4, even 5 years in some second-tier cities. And therefore, a year one return on invested capital on the average new Coffee Heaven store is about 18%, with year two targets of 30%. We've significantly developed Coffee Heaven in the first year, importantly without changing the brand and the offer that's so valued by its Polish customers. When we acquired it, Coffee Heaven was loss-making, and in its first full year under Costa's ownership, it's delivered a PBIT of 1.6 million, which is a 1.8 million pound improvement on the previous year result. We've refocused the company on its core Polish customer and helped it to improve margins and to grow like-for-like sales by a little over 6% in the last year. And we've also restarted its new store opening programme in Poland. Last year we opened 13 stores in the country, and we're targeting at least 20 this year. In the year before our acquisition, the company only opened 3 stores in Poland and was focused on other markets. We will deliver a return on invested capital of 10% on the total acquisition cost this year from Coffee Heaven, and are targeting at least a 20% return. So, moving on to an overview of Costa's cash flows and investments, you'll see that Costa's operating cash flows have grown sharply over the last 3 years, an average of 28% CAGR, which is in line with profits. And operating cash inflows totaled £249 million in the last 5 years. We've been investing about £28 million a year over this same time period into growing our existing businesses, augmented by 2 acquisitions, Coffee Heaven and Coffee Nation. And over the 5 years, we've invested £246 million. About half of this was into new equity stores in the UK, and a further 5% into UK store refurbishments. Buying Coffee Nation and Coffee Heaven cost us £98 million. The international startup businesses absorbed £14 million of investment. Clearly, much of the acquisition capex is immature. I've discussed the returns on Coffee Heaven. The acquisition of Coffee Nation was made 1 day before our latest year end. And we're making these investments into businesses which are delivering strong returns. Costa's reported return on capital has increased from 31% in FY07 to 42% last year. That excludes the assets on the Coffee Nation purchase on the 2nd of March. if you put those into the calculation, it'd be 28% last year. Taking the growth targets that John explained and applying the cost of new units and new stores that I've been discussing, this would imply that Costa will need to invest a very similar amount in the next 5 years to deliver these targets to what it has done in the last 5 years, somewhere between 200 and 260 million pounds. The UK equity business will require the largest element of this investment into new stores and refurbishments. Developing Costa Express out to a 3,000 unit business will require a capital investment of 25 to 30 million, and the international equity and joint venture businesses between them will need somewhere between 35 and 60 million to add between 300 and 500 new stores. And this slide shows how the economics I've been discussing come together with the growth targets to potentially deliver the doubling of PBIT to 100 million in 5 years that John has set out. The targets would see Costa's UK business continuing to be the most important source of both of profits and the profit growth. It would contribute about 2/3 of the overall profit growth, and growth in the established UK retail stores business remains by far the single most important component of growth in our plans. The target would also see China move into profitability and become a meaningful contributor to Costa's profits, and also a source of ongoing profit growth beyond the 5-year period. Coffee Heaven would more than double in size, and like China, would become a meaningful profit contributor to us. So just to summarise, Costa has grown profits in all of its businesses and generated a growing cash flow. Our UK stores are profitable, and importantly, the growth and development of the UK estate has not been at the expense of returns. We've invested into businesses with strong returns, and the economics of the Costa Express machines are strong, and we see this as both as a profitable business and one that meets a clear and distinct consumer need. Our international franchisees are growing their businesses well, and in our equity markets, Costa has established good foundations for profitable growth in the key markets with a solid and investable store business model in China, and is getting close to the break-even point of 150 to 200 stores required in that country. And Coffee Heaven is now profitable and is a growing business for Costa, with plans to deliver a strong return on our investment on the acquisition. So now I'd like to hand back to John to conclude on the session today. Thank you.
Thanks, Matthew. Thank you, Matthew. Just one slide to summarise. I hope what we've been able to demonstrate this afternoon is that not only is Costa a fast-growing business, one that's achieved UK consumer leadership and is building international scale, but also that it's a business with a very clear vision for the future, and a business which can continue to achieve outstanding financial performance. What I'd like to do now is to take any questions that you might have, with the help of my colleagues on the panel and colleagues in the front row here. What we'd like to do is, if you'd be so kind, is if you could raise your hand to ask a question. We'll then bring a microphone to you, and if you could state your name and your company before asking your question, that would be a great help too. So, over to you. Any questions? Yes, sir.
Thank you. Could you give a bit more...
Could you give your name?
Sorry, Simon Larkin from Nomura. Can you talk a little bit about how you... what the strategies behind driving like-for-like sales in the UK business? Is it predominantly volume-led? What's your attitude towards pricing? Just talk a little bit more about sort of how you drive and how you think about like-for-like sales going forward. Thank you.
Jim Slater may want to add something to that, but I'll give you a first response. Our focus on driving like-for-like sales is to ensure that we keep the proposition attractive and fresh for customers. That means that we rotate our food offering quite frequently, and that we seek to deliver 3 or 4 fairly significant initiatives each year. So in the course of the last 18 months or so, we launched the Coffee Club, we launched Flat White. We've done quite a bit of advertising external to the store all around the coffee message. So it's a focus on those sorts of activities which add value and strengthen the proposition. Certainly that rather than promoting on price, which isn't something that we've tended to be involved in the past. But Jim, I don't know if you'd like to add something to that.
I think John has well and truly stolen my thunder, really. We are besotted by the customer. We research customer requirements and opinions all of the time, and it's really important that we deliver a fantastic experience, both in terms of the product range and the service in our stores. So we're constantly understanding consumers' existing and latent needs and providing against that, and that's what drives our like-for-like business results.
Thanks, Jim. Next question, yes, please.
Thanks. It's James Ainley from Citi. 2 questions, please. Can you talk a little bit more about the competitive environment for the Coffee Nation business? I mean, I've seen a couple of competitors, JJ Beano's, Coffee Republic, with similar looking machines. Kind of what sets your offering apart? And secondly, have you done any work on the price elasticity of demand for your product?
Okay, let's take those 2 questions in turn, because I think Scott would, I'm sure, like to contribute to the first, and Jim again to the second. I would just say, when you talk about other unmanned coffee bars, that looks can be deceptive, and there are some significant differences, which I'm sure Scott will be able to describe.
Yeah, there are many companies that will claim to do self-serve coffee. They're quite small scale. You mentioned 2 of them. There are big vending companies too. Coffee Nation differentiated itself by not only providing a system that provided premium quality, but an infrastructure that supported that. So over the course of the decade that we existed and these competitors came along, we built a business of 900 units, pretty much monitoring every single cup of coffee that's sold through that, whereas people that have come into the marketplace or may come into the marketplace are really only focusing on the method of dispense. And it is about the method of dispense. Coffee Nation is about the sum of all its parts, and one of those parts now happens to be the Costa Express logo above it.
And I certainly can say quite categorically that we wouldn't serve Costa coffee through any of those other systems, and the Coffee Nation thing is, what we're focused on. Given Jim's comment, we'll answer the last question or part of it. Jim, over to you for price elasticity.
Thanks, John. Yes, price elasticity is a metric which we measure incessantly in Costa. We have very regular dips into our consumer base there to work out what the price elasticity reaction to the price of a cup of coffee is. And so we always know where the price mountains are, where it is safe to tread with our pricing. And clearly it's a massively important part of the mix for the business. And we monitor it all of the time. A number on what, the price of a... it's the kind of thing which is, we dip every 4 months into the market to get that figure. And I don't think it's something I'd like to enlarge upon at this point, because it's very classified information, as you'd imagine.
Thank you, Jim. Yes.
Thanks. Jamie Roller from Morgan Stanley. Just some numbers questions. Could you just explain, please, the difference in the system sales in the franchise business, the revenues you report, and the contribution in the UK? Did you get 6% royalty fee on coffee sales, plus a wholesale margin on coffee, plus a wholesale margin on selling in consumables? And also on the international franchise business, the difference between your reported revenues and your contribution looks very close, suggesting a very low level of consumables. Just for our understanding, please. And then the other question is just on that slide showing your growth rates and the contribution for new stores. It looks like, sort of back of the envelope, an extra 80 to 100 million pounds of EBIT if you hit your target over the next 5 years, of which, taking today's split, I think about 80% of cost of profit will still come from the UK, despite the overseas growth. Well, are you considering fewer franchises and fewer JVs, but putting more equity overseas so you can sort of address that UK imbalance? Thanks.
And Jamie, can I answer the questions general to our franchise arrangements, and then Matthew, if you'd like to handle the financial specifics. we're not going to disclose our current franchise fee or the price we sell our coffee for, although we do sell it for a price and we do make a margin on it. Those are terms of business that are confidential to us and to our partners. Nonetheless, the economics that you've seen for the franchise business are a pretty accurate reflection of those current terms. As far as international equity investment is concerned, I think we take each case on its merits. We developed a flexible business model so that we could be flexible. And as opportunities present themselves, dependent on how our partners would like to operate, that's how we'll go forward. With BHG, for example, we were always going to do a joint venture because we wanted to work with BHG, and frankly, that was the only way that they would do it. So we were always going to do it that way. It doesn't necessarily mean that every case will be like that, and it doesn't necessarily mean that we'll acquire 100% equity businesses in the future, although, of course, we're delighted with the Coffee Heaven experience so far. But Matthew, would you like to add something to the financial questions?
Yeah, just a little bit. So again, I don't want to say the franchise fee, but it is fair to say in the UK we earn a franchise fee. We then do sell coffee at a price. In addition to which, we also get some upfront fees and so on for opening new stores and new franchises, which are treated as deferred income and amortised, which is why it'll be a little bit higher than perhaps the straight percentage you mentioned here. In international, again, exactly the same arrangement. Yes, because it's international, certain consumables and things are frankly more sensible to source locally. Yeah, so it's always going to be just a touch lower. That's the main piece of difference there. I agree. Yeah, the plans we're saying probably do get us to around about 20% or so of profit internationally by the end of the plan. And as John said, we will be flexible. We will take opportunities as they come along to change the mix. Clearly some of the markets, as you grow understanding of them, as we have more confidence in the brand's extension into overseas markets, we're much more comfortable about taking equity stakes than perhaps we were, in 1994 or 1995 when we took the first franchise markets in the Middle East. But this is the business that we have, and we're showing plans based on the business that we have.
Yeah, a question from over here, and we'll come back to you.
Thanks. It's Tim Ramskill from Credit Suisse. I've got three, if that's okay. The first is just, if you look at your future plans, specifically in the UK, what proportion do you expect to be effectively new supply versus replacements? I'm thinking of replacement of going into places like Esso or Tesco, where you're effectively replacing an existing coffee shop operator. Secondly, obviously Starbucks, a couple of years ago now, having grown very aggressively in the US, had to sort of retrench to a certain extent. So what did you observe of that, and how do you avoid any sort of necessary similar effects for yourselves or issues for yourselves? And then the third question was just on future franchisees, what's the pipeline of franchisee interest, and have you got plenty of visibility on that? Can you share any numbers with us?
I think I'll take each of those questions in turn, if I may. The question about new versus replacement supply isn't actually one of the ways that we plan our business necessarily, but it is certainly true that almost a half of the stores that we've built, fitted out over the last few years have been replacement supply, and it's a great source of business for us. Even when it's not true replacement supply, we do find situations where we're drawing custom from other coffee providers in places where we operate. Going forward, I'd suspect that would pretty much maintain. We've got a great relationship with our concession partners. We see further great opportunities with some of our corporate franchise partners as well. So I'd expect that would broadly continue. As far as the US example of oversaturation of markets is concerned, I think there are some learnings from what happened in the United States. They principally focus upon the oversupply of stores to specific trade zones, adding too many stores in individual trade zones. The not at all apocryphal stories of seeing Starbucks on all four corners of a junction, for example, where there just isn't enough incremental business to support the growth in stores. The second thing, and we've certainly learnt from this, is oversupply to the marketplace of small units. So you're kind of trying to respond to demand by adding more and more same-size units. We'd rather go into new trade zones, and we'd rather go into them with big stores. And there are plenty of trade zones that we're not in at the moment. You only just have to travel around, posher London suburbs, and you can see that. And thirdly, as far as the pipeline of franchisees are concerned, there is a ready market for Costa franchise partners in the UK. We've no shortage of supply of candidates, but we set pretty high standards. Our individual franchisees operate great stores to very high standards, and we want to maintain that. So it's not easy to become a Costa franchisee. Can we just go back over here? I think you had, yeah.
Thanks. Yeah, just a couple of questions. In terms of those penetration rates you gave us on slide 34, have you got any sense, be it from other industries or competitors elsewhere in the world, as to sort of where those can get to in terms of the number of visits every 3 months? Secondly, on the sales per square foot, you talk about the increased square footage. How is sales tracking with that? Are we talking about increasing sales in line with the square footage, or is it just about preserving the brand?
Again, Jim might have a better example than I of this, but it's tough to find real comparators for those kinds of penetration numbers. The only kinds of F&B businesses that have higher penetration numbers would be the bigger QSR chains. But they certainly do have significantly higher penetration numbers. And in terms of visits, our customers are coming on average just once a week, which I find quite staggering, really. I don't know anybody who only goes to a coffee shop once a week. So I think there is really significant opportunity there. But Jim, do you have anything to add to that?
I think one of the very encouraging learnings from our coffee club database is that we are seeing fairly dramatic increases in penetration and in usage when customers join the loyalty scheme. And because of the bespoke nature of promotions, which registration enables us to give, that's being very effective, increasing the rate of visitation to our stores. So that's proving a very effective marketing mechanic for us. And that's one of the reasons why I think John emphasised that in the presentation.
Okay. As for the second point, the focus on buying the biggest stores really is first and foremost about building the brand. So that we can buy better stores, we can cope with future demand increases and provide a better experience to our customers. If you go to, let's say, Great Portland Street today, the amount of space that individual customers have is better. It's a very busy store, but it doesn't ever feel quite as crowded as it might. I guess in total our sales haven't quite grown to the same extent as that increase in square footage, but they are growing, and we're investing in stores that will be there to meet future demand, not just the demand that we see today. But Clive, I don't know if you've got anything to add to the store footprint that we're developing and the changes that you've seen whilst you've been acquiring these hundreds of stores?
I've been buying these sites for about 10 years now, so I have seen quite a dramatic change. And what it is the huge amount of footfall that are now coming into our stores, and hence the demand for larger stores to cope with that demand. So it's something that me and my team have really focused on, large, bigger stores that can cater for demand today and tomorrow. And also, it slightly insulates us from future competitive erosion, because we have the largest and the best store to cater for that customer demand.
Thanks, Clive. Yeah, should we go over there?
Kate Petham, UBS. At the presentation for the full year results, you talked about investing in the stores, particularly labour, to improve speed of service. Is this something that we are going to see consistently? And maybe you could bring us up to date on outcomes from that investment.
Okay. And I'll ask Adrian to give you the full SP on that. But the focus was to increase not just speed of service, but the friendliness of service, and we've taken steps to improve both. So, Adrian, I don't know if you'd like to comment on that.
I will do, yes. There was two things that we invested, not just in labour, but in changing our service style to reflect the 2 or 3 services that we give to people. Before we were quite robotic and set questions, so that we were asking customers 7 to 10 questions when they were ordering a cup of coffee. We trimmed that down, and we're now more reflective of the customer type, to take out steps within that service time. We also have invested labour into our larger stores, and we've also invested in putting in more tills, more coffee machines to be able to adapt and take the capacity through the growth that we've seen recently.
Thank you. Over here again.
Hi there, Tim Barrett from JP Morgan Cazenove. You mentioned, John, in your presentation, 2 to 3% sales growth needed to cover costs, but the current trading recently at the results implied that it could well be below that. So have you got any thoughts on defending margins this year?
Well, as you know, we're not going to comment at all on current trading. What I will just say is that over any kind of medium-term perspective, Costa has demonstrated a remarkable ability to sustain like-for-like growth. I've seen our 36 quarters of like-for-like sales growth described as volatile in some quarters. It's always been volatile on the positive side of the line. So, yes, it's going to be a tough year this year, everybody knows that. But in anything like the medium term, you know, I'm fairly confident that we'll see continued strong performance in our business. The growing demand for quality coffee and the growing appreciation of our brand within that demand, I think, give us, you know, real cause for, you know, very positive optimism about the future.
Can I ask a broader one? Starbucks talk quite a lot about coffee at home, single-serve coffee. Is that a market that you're interested in or have looked at?
It's not a market that we're currently interested in. We have seen some of the things Starbucks have done. Some of us were in the States quite recently, where we noticed a campaign that said that Starbucks coffee at home tasted as good as the coffee in the Starbucks shops, and we agree, really. But we have no real plans to get into instant coffee or things of that nature. None at all. Sorry, towards the back here.
Hi, Jeff Collier from Deutsche. 2 questions, please. Firstly, I seem to remember you signed the Chinese and Russian joint ventures at roughly the same time, and the Chinese joint ventures, albeit after a bit of a slow start, seem to be stepping up quite aggressively. The Russian one doesn't seem to have moved that much at all. Do you think you've gone in with the wrong partner, and is it too late to change? And secondly, when you look at the number of active club card members in the UK against the number of people who've got the club card, there's quite a massive difference. How do you get the people who are dormant club card members to get back into the shops, especially when the club card members spend so much more than the average non-club card member? Okay.
Sorry, Jeff, I'm not wearing my specs, so I didn't recognise you from this great distance. Question about Russia first, and then about the club card. I think you summarised the situation in Russia reasonably well, except when you got to the final part, where we're a great partner. There have been difficulties in the market. It's gone slower than we had expected. The opportunity may not be quite as large as we at first thought, but categorically we're with the best partner we could find then in Russia, and the best partner we would want to be with in that market today. But Andy, I don't know if you'd like to add to that at all.
Yeah, I would say that what we found was that the market is perhaps more limited than we originally put into our prospectus. Moscow seems to be where it's at. That's been more difficult, particularly in terms of rentals in that market, to find space that's large enough for us to establish our footprint. So we've had to go slower and make sure that we find profitable space to do that. The partner is working with us on that. When we get the right space, we're actually seeing very good like-for-like sales growth in those stores. So we're going slower than planned, but we really do feel that we're okay in terms of what we're doing there at the moment with the partner we're with.
Okay. And as for the coffee club card, I understand what you're saying. I do get your point. I think 1.2 million active cards and the registration numbers about 1.3 million, I think is fantastic. But Jim, I'm sure you can talk about the dynamics of the scheme.
For sure, yeah. The 1.2 million figure is the number of people who are using the card and are registered. Therefore, we have an ongoing relationship with them, and we leverage that promotionally, and the customers in that group are delighted. And we have a total of 3.8 million people who use the card on a regular basis and have done so in the last 8 weeks. So there's a balance of folks there who haven't registered, and therefore the crazy fools aren't benefiting from the promotions that they might receive. You're dead right. It's an objective of ours to bring more and more people into the fold to benefit from those promotions, because we know it increases frequency and it increases average transaction value when those people do come into the fold fully.
Okay. Yes, right at the back, please. Right, back in the centre.
Hello, John Beaumont from Matrix. Thank you. I just wanted to ask a couple of questions on the UK franchise business. First of all, I wonder if you could tell us how many stores on average does a typical UK franchisee have? Secondly, what's the typical, how much do they have to invest usually in the stores? And what's the average EBITDA do they actually generate? And if you could expand that in about what sort of controls you have over the franchisee. Do you know all of the sales that are made over EPOS, and do you have sort of head lease on the sites, that sort of thing?
Okay.
Thank you.
In terms of the EBITDA that they make on their business, that's information that we certainly wouldn't want to share if that was that particular part of the question. In terms of the numbers of stores that the franchisees have and the controls that we have over them, Adrian, if you wouldn't mind just filling us in on those details.
Individual franchises, roughly 280 stores. We have around about 32 partners, and they'll have anything from between 2 to 3 stores to our highest individual franchise will be just over 20 sites at the moment. Control-wise, they follow the same brand standards as all the Costas throughout the world. We have an operating manual, and we audit that 4 times a year with them. They fall out of that cycle and have problems, they'll re-audit, and then from then on they'll follow a normal franchise agreement through that to manage in or up to back to the standards.
Okay, thank you. Yeah, here we go.
Thanks. Yeah, it's Vicky Lee at Bucks Capital again. Just can I dig a bit on China? In terms of sales per store, I appreciate it takes longer to ramp up, but just sort of what is the ultimate sales per store compared with the UK, for example? And the same question really, how do you see it long term from a margin standpoint? I think Starbucks alluded to the fact that they're getting better margins out of China, even if the sales are considerably lower. Related to that, what does pricing of coffee look like there, and the competitive landscape?
Okay, so it's pricing, sales, and competitive landscape in China in a bit more detail. Well, I'm delighted to say we've got Paul and Lo Zhong here, so between the two of them, I'm sure they can give you a bit more information on both of those things. Perhaps talk about the latest Beijing site would be quite an interesting way to start.
The actual store sales levels are lower in China. We are finding that as a result of probably brand awareness, and one of the big things we're doing is pushing brand awareness. And where we've got big locations, that is certainly helping us. We've just secured a major site in Beijing Airport that will significantly improve both the awareness and the sales for the whole of the stores. What we're finding is the thing with China is the scale, that as you move out into the sort of tier 2 cities, you've got huge scale and you're starting up a business almost every time. So you face that problem each time you go in there. But as each store develops and grows, and as you get a core 3 or 4 stores, we're finding the overall per store average is increasing substantially, and you saw that in the slide. So I think that's very good. In terms of the competitive landscape, we are getting a significant amount of local competition. We have got competition from Starbucks, which I think is probably the biggest competitor over there. And we've got other competition, such as 85 Degrees, which is a Taiwanese brand, and they are competing for locations and sites as well. But we are able to do well on this now because we're becoming well known, and certainly in Beijing, we are being asked by landlords to go into locations, and these are a more high quality location, and we are getting quicker and better per store averages in the stores. I'm pleased in the way that that's going. I'm confident that we'll continue to drive that. You saw the opportunity that's in there, and that's how I would describe China. It is one big place of opportunity for us.
Any further questions? Yes, I'm sorry, you've had your hand up a couple of times. Just here.
Nigel Hicks from Liberum Capital. 3 questions. Firstly, how do you decide between equity or franchise for a site, say in the UK? What are the issues there. Secondly, within 22 million of overheads, how much of that is to do with your equity stores, franchise stores, and maybe just sort of the base cost? And what causes you to close franchise or stores in general? And how many would you sort of cut in a year? What would be a normal level?
Let me answer the third question first, because I think I can answer that one, and then we'll go to Clive or AJ about the equity versus franchise bun fight that sometimes goes on, and then to Matthew to discuss the overheads. We don't close that many stores a year. It's usually a single-digit number in the UK, and we close them when A, they're losing money, and B, there is no reasonable prospect of turning that around. And I say no reasonable prospect of turning it around because there are stores quite near here, for example, that we might have closed 3 or 4 years ago, which are now very profitable. And the different maturity curves that we see in different markets mean that we have to watch these things quite closely. We have very few loss-making stores, and we don't hang on to them for very long when we do. Another thing that is recently happening is that there are 1 or 2 mothballed stores that were reopened because they are now viable. So it's not really a big issue for our business. But I don't know, Clive or Adrian, if you want to talk to either that question or the equity versus franchise question.
On the equity versus franchise question, we've got a very detailed demographic model. So what we identify is who the potential customers are, which then hopefully will be able to give us a broad sales prediction. And on that basis, we then see whether it should go to equity, which would be the higher level stores, and the lower level stores we would see more suitably placed with the franchised estate.
Okay, that's great. No, we have certainly, however, seen franchisees open stores that we thought would be small and might be challenging for us as an equity operator, and they've turned out to be great sites. So the potential for Costa in smaller and smaller locations, either as equity or as franchise, consistently surprises us. We can take Costa now down into very, very small trade zones, particularly in provincial towns, some of which are barely bigger than villages. It's really quite an exciting growth opportunity. But Matthew, would you like to talk to the overhead question?
Yeah, sure. So really, I think the question was what proportion of the overhead is retail supervision and what people sitting in an office. We don't actually employ that many people sitting in an office. Our office is about the size of this room. So that probably gives you a bit of a flavour. In the very short term, the rough rule of thumb I use is around half of it is variable and half of it is fairly fixed. However, looking at over a 5-year plan to build, to double the size of the business and take on all the additional markets, I wouldn't expect that to hold. We're clearly going to have to take some step costs.
Okay. Yeah. Back to the centre.
Yes, it's Jeffrey Harwood from Oriel. 2 questions. First of all, on the overseas joint ventures have a habit of not lasting through the medium term. Do you have the option to buy out your partners? And secondly, how significant are the advantages to Costa of being part of Whitbread?
Yeah, I think one of the reasons why joint ventures sometimes fail, particularly international joint ventures, is that people fall out when their motives aren't aligned, or when their motives change, or when you just simply found the wrong partner. Clearly our contractual arrangements with our partners are confidential to us and to our partners. There are a rich variety of provisions of various sorts to help us to reconcile debates or discussions. We think that we've chosen great partners who are completely aligned with the way that we see the development of the business. They also have values that are completely aligned with Whitbread's, and that's one of the things that we particularly look for. And I can certainly say that in the case of BHG, and if you look on their website, values, funnily enough, is one of the first things that they talk about. So that's the first point. Being part of Whitbread, I'm sure Andy would like to to say something about this. But firstly, and I'm speaking, I think, for the Costa team. I think Whitbread has been a fantastic owner of Costa. We've, as has been said, trebled the size of our business in a few short years, and we've quadrupled the profits that the business generates. And I think we've also been, fantastic for Whitbread shareholders. You look at our growth rate, you look at our returns, I think this is a great shareholder story for Whitbread investors, and the combination is fantastic. Half of this team come from Whitbread. It's not just money that goes in, it's people, it's know-how, and it's the strong values that underpin how we operate. And I think that makes a huge difference. But Andy, I'm sure you'd like to add something to that.
Only a little bit to say that I think I'm still fresh and objective here. I think the proof of the pudding is in the numbers. The numbers for Costa are clearly outstanding, as I said, but they're also outstanding compared to the growth of their competitors. And I think that what Whitbread has done, as John said, is to add financial capital, human capital, but also it's provided the right investment and risk framework to develop in markets like China. We're here today talking about really a very exciting opportunity, but Costa's been in China for nearly 5 years. It's taken a long time to get to where we are now. And we compare that with companies like Starbucks, which has got a huge North American base, and therefore to go out into some of these markets is a much lower risk. Whereas I think within the context of the Whitbread framework, Costa's been able to do some quite exciting and bold things, and we're now able to see the fruits of that, both the rapid growth in the UK plus some of these really exciting growth platforms internationally.
Well, I think the one thing I'd add, if I may, just to that is, in the late 80s and to the mid 90s, there were half a dozen different coffee shop chains and sandwich chains that were either founded or acquired in that period of time in the UK, and they were all pretty much of a muchness then. If you look at the situation today, Costa is about 4 times bigger than the next biggest one, and Costa is clearly the one that's been owned by Whitbread. I think the history of the company's performance proves the point, really. But moving on, yes.
Thanks. Afternoon, it's Simon French from Panmure Gordon. You've got about £112 million of invested capital in Coffee Nation, Coffee Heaven and other start-up markets, not earning you very much at the moment. When will that hit the 28% group return?
I'm not sure when Coffee Nation will exactly hit 28%, but we've owned it for about 2 months, I think. So I think if we'd done it in 2 months, it would have been pretty fast. Coffee Heaven, I think, will get to where we want it to be over the course of the plan period that we're talking about. I think Matthew talked about 20% for Coffee Heaven, and I think there's every sign that it'll get there. We're growing that business very fast. They're great people. They're just like Costa people, and I think that business will develop very strongly.
And just a follow-up, if I may, Andy, you mentioned Starbucks in North America. Why the reluctance, given you outperform them in every other market in the world, to take them on their own backyard?
That is always an interesting question within Costa circles or Whitbread circles. We're focused right now on going to places where there's a level competitive playing field. That doesn't mean that we won't one day go to the United States, and there are clearly a lot of coffee drinkers in the States who would be an appropriate target for us. I think one of the things that is changing over time is that as our brand becomes better known internationally, the possibility of going into the US becomes more viable, certainly in parts of the US. It would have been impossible a few years ago. It might be possible in a few years' time. But our current plans are to focus on where the future volume will be, where the future growth will be, where tomorrow's coffee consumers are, is the current focus. Yeah, come back over here.
Thanks. Tim Ramsell again from Credit Suisse. Just a quick one on the Express business. So looking at the numbers, it looks like those machines do just less than £100 a day of sales, which doesn't sound on the face of it like a massive number. So I just wondered if you could share with us a bit of detail as to, firstly, what's the minimum sort of size location you can put those machines in, you believe, and also maybe at the other end of the scale, how significant some of the sales contributions can be from those machines in high footfall areas.
Okay. Scott, I think if you wouldn't mind taking that question directly.
Yeah, £100 doesn't sound a great deal, but we are able to get the return on capital employed still at around the 60-70% by bringing the cost of capital right down. The key then is at that low level of capex, you can increase the level of penetration. So we have machines out there selling £100,000 of coffee a year. That's a third of an equity store from 1 square metre. We equally have sites that might only do £100 a day. The economics, though, that drive it are the return on capital employed, and it's a varying capital cost.
We're keen to leave lots of time for you to taste the Costa Express and also to chat with the team informally. So maybe if we could have the last few questions, please.
Any last questions? Yep.
Hi, Alex Sweet from Highclere. Could you just comment on the consumables? Because you spoke about coffee inflation this year, but I imagine there are certain pressures also on the consumables side. And could you just describe what you do with that whole account? Is it one large account with someone like Bunzl? And how do you manage any pressures you're seeing at the moment?
Okay. Matthew, could you?
Yeah. There's a huge amount going on in there. So just to touch on it, so yes, we do use Bunzl to supply many of the more basic products. And in fairness, we're not seeing a huge amount of inflation through that. So when I sort of talked about 2%, that would be pretty much right for that kind of stuff. What we're doing really in the higher cost items, such as the cups, what we've done there is we've made a huge investment of time and energy into changing the cup. We've now got pretty much the greenest cup that's possible on the market. We've gone into a global supply contract on that. And doing a whole load of things like this where we're building our scale out. So actually we're offsetting some really big commodity prices by consolidating volumes, doing things more cleverly and differently. And our growth is allowing us to do that.
Okay. One last question, perhaps? Okay. Well, let me finish by thanking John and his team for their presentation. I hope that we've conveyed our excitement for the future and explained how we intend to deliver our ambitious growth plans and how this will translate into substantial value creation for Whitbread shareholders. Costa has a great team of people with a proven track record of rapid and profitable growth. Please take the opportunity to talk to the team over coffee, and I look forward to reporting our progress, and thank you very much for joining us today.